Okay, everyone, I suggest we slowly resume. So, very glad to hear that the presentations provoked some interest and some discussions, corridor discussions. So we are getting to our next morning session, the second morning session. So the next speaker is my good friend, Alex Eleftheriadis. He's one of the rare people that I know that have seen technology development from all angles, from the three major angles, the one of the researcher, one of the entrepreneur, startupper, and also the angle of venture capital funding. So I could not think of a better choice for this session and to give to our students this valuable insight that he has from his career. So with no further ado, I'd like to welcome Alex to the podium, and the floor is yours. I would look forward to your talk.
Thank you and good morning. So as Constantino said, I was not always in venture capital. I started as an electrical engineer. Then, here at the National Technical University of Athens, went to Colombia to do my PhD, stayed there as a professor for 10 years. And then I switched to entrepreneurship. I started a company back in 2005, working in video conferencing products, way before, Zoom and everything became applications of common use. The company was called Video, was sold 3-4 years ago to a Canadian company called Lens House. And after that, I decided to move over to the other side, so to speak, the investment side. So I tried to put together sort of information for people who are, on the research side of things, on what venture capital is and how it works. And first off, a little bit of history. Venturing is very old. I mean, the old explorers were raising capital to go out and, discover America and what have you. But the notion of venture capital, as we understand it within the scope of technology, started in Silicon Valley. Now, where is Silicon Valley? I hope everybody knows. In case you don't, this is the United States, right? To the right, you have the East Coast with New York. To the left, you have the West Coast. Okay, and down there is San Francisco. In fact, let me blow it up. And there is this small area. Let me see if the pointer works. There we are. So from San Jose up to San Francisco, that's Silicon Valley. Okay, actually, Constantinos knows that place very well as well. Okay, so that small area has been the center of the venture capital sort of revolution. But of course, now it has expanded, and it's something that is around the entire world. It's interesting that Silicon Valley was started by a professor at Stanford called Fred Terman. He ended up also being the dean. He was the guy who gave money to Hewlett-Packard to start the company. Okay, and Hewlett and Packard are two people. Okay, they were engineers. They were students, that's true. And so they set up, the proverbial startup in the garage, which is actually true. And it's also interesting that the first product they sold were electronic oscillators, and they sold them to Disney. And they were used in the movie Fantasia, which was also the first movie to be done in stereo. So, you see all these interesting connections. Now, Terman was very actively developing the concept of having companies surrounding Stanford, okay? And in fact, he brought Shockley in 1956, after Shockley, discovered the transistor and won Nobel Prize. And Shockley had a company. He was a very bad manager. So 8 of his employees left and started another company called Fairchild Semiconductor in 1957. And Fairchild became the breeding ground for new companies. 38 companies were created from Fairchild employees. One of them was Intel, okay, which was started in 1968. And as of, I guess my data was in 2020, it had 110,000 employees and $77 billion in revenue. This is sort of the Silicon Valley story, meaning, 40, 50 years ago, there was nothing. And, a few people thought of an idea, right, of the integrated circuit. They create a company that changes the whole planet, okay? And this is a process that has been repeated again and again and again. And in fact, in recent years, over the past 10, 15 years, it has accelerated, meaning the creation of companies that have created transformative products that we now use, around the globe, okay? I was driving here, by the way, and I was using Zoom to watch the webinar. There was traffic, so this way I could, first of all, listen to the presentation and also monitor if I was going to make it on time. The thought of this, right, 20 years ago, that we'll be in traffic, listening to what was going on here, it will be science fiction, okay, for sure. Okay, so what is venture capital? So basically, it's equity. This means you get a percentage in the company that you invest in. It's not a grant. It's not a loan. You are not expected to give back the money in 3 years with some interest. Okay, it's all about innovation. Okay, so venture capital is about technical innovation. Sometimes it's also about business model innovation. For example, what TaxiBit did, right? Technologically, Bit is not particularly innovative in terms of the software implementation, but it did disrupt the business process of getting a taxi because it allowed you to basically connect directly to a driver, without having to wait on the street.
Visitors may not know Bit.
No, Bit is like Uber. Bit is the sort of it's a local version of Uber. Okay, if you don't know Uber, I'm sorry. I'm really sorry. So it's also high risk and high return. Okay, so because it's a very high risk business, you want to invest in companies that if they are successful, they will have significant return. Okay, this way you will make up for the companies that will fail. Okay, this is important because sometimes people have good ideas for companies that, let's say, could have a few $1 million in revenue, profits. You could sustain 10 people, salaries, etc. Not good enough for venture capital. In venture capital, you need to have a company that will grow fast and grow big. Okay, so it doesn't mean that the other style of company is not good to have or to invest in, but it's not appropriate for venture capital. It's appropriate for other types of investment. Okay, and very important. You need to grow the company and you need to exit. Why? Because you invest in the company, you take a percentage. At some point, you need to get your money back with multiple times, hopefully, right? So there has to be, as part of the plan of the company, that somehow the company needs to return money back to the investors. And there are two ways to do this. Either you will sell the company to another bigger one, or you will do what's called initial public offering, meaning you will sell a percentage of the company to the public markets, to the stock market. Okay, so you go to New York, NASDAQ, you take 10% of the company in terms of shares, and you offer to the public. That will be the initial public offering. At that time, early investors put their shares out to sell them, and that's how they make their money. Okay, so the exit part is very important because remember, it's not for the investor. It's not enough to create an exciting product. Okay, in the end of the day, because they're managing money, they need to see also that after the product is successful, somehow the investor will get their money back. Okay. So what are the stages? You start first of all by creating the team. Very important. People don't like single sort of founder ventures. Okay, so it's good to have at least two people. Okay, for many reasons. And this is a process that could take months, years sometimes. So you have an idea or you want to do it and you meet with a couple of friends, you discuss it. I remember back in 94, 95, I was going out every Wednesday with some friends discussing potential venture ideas. So, it percolates until find something which is interesting. At any rate, at some point, you decide to make a move, and there, what you probably want to do is get some initial funding, either from your own funds or from friends, friends and family, or angel investors, individuals who are willing to invest 10, 20, 50K, 100K to a company so that they can, they can be very early investors and potentially have a significant return, okay? So that's typically in the range of 100, 300K. So that will give you enough money, let's say, to hire contractors and get started, buy resources in terms of computing, Amazon Web Services, what have you. Usually, to make things simple, because these people will want to have a percentage in the company. Now, it's too early, though, to have lawyers and do all sort of legal agreements, etc. So people over the years have devised a very nice mechanism, and that's why I mentioned it here. It's called a SAFE, which is a simple agreement for future equity. It's a 1 or 2 page document created by Y Combinator, and very clearly and easily says that, I'm going to give you this money. When you raise capital, right, I will get the corresponding equity, typically with some discount or some, meaning cheaper than somebody who would go in late, and with some cap in terms of the valuation. We'll discuss this in a second later. So this is useful. Why? Because at the point we are creating the company, you don't want to start spending time and money to set up a very complicated legal structure. It costs money and time, and you're not sure yet if it's going to fly. So that's a good way to get started, to have some paper to give to a potential investor without having to spend too much money in legal work. So if you Google it, if you Google SAFE, you'll find the documents. Now, after the company matures a little bit, you might be ready to get your first institutional money. Okay, so you approach a venture capital firm and you do what's called a Series A. Okay, and why is it Series A? Because there's a Series B, C, D, etc. Typically, that's in the $1 to $5 million range, especially for Europe. In the US, the numbers, can be much higher. It also depends on the subject matter of the company. Hardware-oriented companies tend to spend, much more money. And then after the company grows, it might do additional rounds, Series B and C. And every time, typically the ticket, the amount of money raised usually increases, okay? And then at the end of the line, you'll have, as I said, either a sale of the company to a bigger one, or you'll have what's called the initial public offering, where the company might go out and raise $100 million, okay? Now, ideally, this path should take, 5 to 7 years, at least ideally from an investor's point of view. You want to get in and out in a reasonable amount of time. Venture capital funds have a lifespan of 10 years, roughly. So what you want to do is have the companies either fail or succeed within that time window. You don't want to have sort of zombie companies, meaning they're still around, they didn't exit, because when you need to shut down the funds, you'll have shares in these companies and you don't know what to do with them. You'd rather convert them to money and distribute the money to your investors. Anyway, now I want to explain a little bit how the valuation process works and the investment works, because that's something that most people are not familiar with. So I took a hypothetical example. I have a John and Mary that create a company. So they get together and they decide to invest $500 euros, okay, as initial capital for the company, okay. And they each have the same percentage. So what they do is they set up the company with 100,000 shares, okay, here. They take 45,000 shares each for the $500, and they leave 10,000 shares to be given to employees, future employees, okay, as an incentive for them to participate in the company, okay. So the pre-money, as it's called, valuation for the company is zero. The company didn't even exist, so there's no value, right? After the John and Mary put in the $500 each, the total capital invested in the company is 1,000. So the so-called post-money valuation, meaning after the capital increase, is $1,000 or euros, okay? So that's how we start. Now, John and Mary work hard, for whatever, a year, a few months, and the company grows, they create a wonderful product, and they decide to bring in an institutional investor, okay? So Happy Investing shows up, and they're willing to put $1 million into the company, okay? And after negotiating with the founders, they agree that the investors would take 20% of the company, okay? So the way this would work is, from the 100,000 shares, the company will issue an additional number of shares to sell to the investors. So if in the end the investors have to have 1/5 of the company, then they need to issue an additional 25,000 shares to give to the investors. This way, the 25,000 divided by the total number of shares in the company, which would be $125,000, would be 1/5. Okay, so you see that they create this additional, they issue the additional 25,000 shares, which they will sell to the investors. Okay. Now, what's interesting is that if investors are willing to pay 1 million for the 20%, okay, what is the total value of the company? Obviously, since they are giving 1 million for the 25%, so for 20%, right, the entire company has to be 5 times 1 million, so it's 5 million. So what you have here is that what the so-called post-money valuation is 5 million, or equivalently, the pre-money valuation is 4. In other words, the investor walk in and they say, okay, we think your company is worth 4 million. We're willing to put another million. Okay, that's where the 20% will come as well. Okay, so you have the pre-money at 4, the post-money 5. Okay, and what is the per share price? You just divide the total number of shares with the valuation of the company, the post-money valuation. But what is very interesting to observe is what happened to the founders. The founders, they have the same number of shares. The percentage of the shares in the company has decreased. It has been diluted, right? Why? Because you added additional shares for others. So your percentage will shrink, okay? But let's see what happens to the value of the percentage. Because of the different valuation given by the investors, right? the founders, without doing anything except working hard to build a company, suddenly their percentage, which has been reduced, is worth a lot. In fact, if you do the calculation, John and Mary will be worth 1.8 million, their share in the company. So they started with $500, right? And after the investment, right, the nominal value of their equity in the company is 1.8 million. Okay, and you see now how capital appreciates in value, and that's why you see, for example, Jeff Bezos made $10 billion this week. He didn't actually work to make 10 billion. So it's even journalists, I mean, they use a wrong expression for this. What happens is his share in Amazon, because he still has a very substantial share in Amazon, the value of his stock goes up and down depending on what is the current value of the Amazon stock in the stock market, okay? Because it's publicly traded. So you go in and you can buy, and sell it, right? So that determines the price of the Amazon stock. And then when you look at how much money Bezos has, you multiply his shares times the current value of the Amazon stock. So at any given day, this might go up and down in billions because Amazon has become such a huge company, and because Bezos has managed to keep such a big percentage of his equity. Okay, this is not common, right? But it happens, and that's what drives his tremendous wealth. Okay, the same also for Musk. Okay, who also has substantial stakes in now in all his companies. Okay, so that's how this works. So. Now, let's look at exit scenario for happy investing. So if the company, let's say, sold in 5 years, let's say for 50 million, remember happy investing took a 20% share in the company. So what they would do is, out of the $50 million that the buyer will pay, happy investing will take, 1/5. So they're taking 10 million. Remember, they invested 1, they take 10, great, that's fantastic. 10x return, okay? Good number. And in venture capital and investing in general, people use the term IRR, internal rate of return. This is a measure of the return, but also takes into account time. In other words, the later I get the money in, the worse it is, right? Because it's great if it's 10x, but if it's 200 years, maybe it's not so great, right? So you have to factor in the time, and that's a way to calculate it, okay? Another exit scenario, IPO in 5 years, the company sells 10% of its, issues an additional 10% of stock and sells it in the stock market. Okay, there typically the valuations will become like 500 million or even more. Billions of dollars could be the corresponding valuation. So if happy investing still is at 20%, obviously they would take huge number of shares, and I calculate the number is 90 million. So you can see that the returns are stratospheric. Okay. But this is why you end up now in Silicon Valley with funds that have billions and billions of dollars of assets under management. Why? Because this scenario, right, was not uncommon at all. In fact, for several periods, over several decades, this was happening and again with several companies. And so this generated returns for the investors and the founders, who then put the money back into VCs. Okay, so they reinvested the capital. So that's how now you have funds who started managing $150 million and now they're managing billions of dollars. Okay, this money was created, essentially through this process. Okay, it's a self, perpetuating cycle. Okay, and the founders, of course, now after the IPO, they're worth 160 million. Okay, so noted that. It doesn't mean you can sell all your stock, but so it's a nominal value. But of course, usually what people do is just sell a percentage so they can, buy a house, buy a car, whatever. Make sure they have enough money so that regardless what happens to the stock, they're sort of set. Okay, of course, there are bad scenarios as well. And unfortunately, these are also very common. You can have a down round. So you get investment, but unfortunately, the valuation of the company is lower than the previous round. So you get dilution without appreciating in value, okay? And this can happen if, you thought you would sell X, you didn't, and now you run out of money, and so now you're struggling to make ends meet. So you have to sell equity for lower cost, okay? And the worst of all is liquidation. The company cannot meet its, obligations, and you sell it, okay, or you sell its assets. And in these instances, typically the institutional investors will have what's called a liquidation preference, which means they will take their money with some interest before anybody else gets any money from the company, even as a founder. So usually you pay off debt, let's say, if there is any, and then the investors will take whatever money was paid for the assets, and then whatever is left will be shared by the common shareholders. Okay, but again, that's not a nice scenario, but it happens. Okay. Very important in this scope is the stock options for employees, because in addition to the founders, typically in a venture capital, in a venture, the employees also participate. So what happens is you pledge 10, 20, 15% of the total equity of the company to be given to employees, and it's given as a stock option package. And the way this works is that the board approves the shares, sets a price for the option, okay? And then what happens is when you join a firm, as part of the offer, you'll be given a number of options, okay, with a set price, and your right to purchase them will basically vest over a period of 4 years. So every month you lock in 1/48th, let's say, of the total amount of shares, okay, and usually there is a trial period of 1 year, so there's a 1 year cliff, so you get nothing for the first year. After the end of the first year, you get the full 1 year worth of stock, and then it keeps increasing, linearly, okay? And what happens is, again, these are not stocks, these are options. This means this gives you the option to buy the stock, right, when you want. So typically what happens, you want to exercise the option when you can buy it and sell it for a profit, okay? So when the company is sold, typically all options vest immediately, okay? Or if a company does an IPO, at which time you can say, okay, I want to exercise my right. Okay, how much is $10? Okay, and I will sell it for, let's say, 10,000. Okay, usually in the same day you'll buy and sell it, so you don't even have to physically put in the money. I mean, it's done in one shot. And out of the sale, you will also pay taxes, because if you sell something for a profit, you have to pay capital gains tax. Okay, where do you find the money? Because you sold the stock. Okay, so that's how the mechanism works for employees. And by the way, thousands of employees in the United States and elsewhere have become millionaires through this mechanism without being founders, just being part of the company, being early employees, having substantial stock, or having stock that was very cheap. The sooner you join a company, the cheaper the stock will be. Okay, so that's an incentive to join companies early. Okay, which also mitigates the risk. Okay, I mean early, but then again, it's very cheap. I'll get the stock very cheaply. So if it's successful, the returns will be correspondingly much more significant. Okay. As I said, typically these options vest immediately if there is a sale or IPO. One caveat is that if a company IPOs, usually the optionees cannot sell for a period of 3 or 6 months, which is it can be nerve-wracking, because you can be essentially a millionaire, but without being able to enjoy your proceeds. And of course, you monitor the stock price, and if it goes down, which has happened, by the way, in several companies, okay, you have the unfortunate, reality of seeing your newly found wealth disappear or diminish. It's also important for companies that take a long time to find their way, that usually options expire in 10 years, which means at the end of the 10 years, you have to decide if you're going to buy them or not. And sometimes it's not easy. And I want to quote a colleague of mine at Columbia, Yehiam Yemini, who told me when I was starting actually video, he says, Alex, it takes 5 years for a company to succeed and 10 to fail. Meaning, because failures take such a long time, because you keep struggling, you keep working to make it a success. So usually it's a protracted process. Anyway, so a little bit about the venture capital terminology. So partners are the people who work in a fund and manage the investment. They make the investment decision. Associates help them. Okay, they don't make investment decisions. They do research. They speak with companies. They go to events, make speeches, whatever. But they facilitate the work of the partners. Limited partners are actually the investors. They are the people who give their money to the partners to be managed and to be invested. Okay. Usually the partners themselves are investors in the fund, so they also put in their own money. It's the so-called, you have to have skin in the game. In other words, if I believe I can make a return for Konstantinos, I can make a return for myself. If that's the case, why don't I put my own money, to manage it? So it's expected that partners will also invest their own money in a capital. Capital under management is the total amount, that the fund has to invest. Okay, and it's a sign of how big the fund is. Okay, capital call is a process of getting money from your limited partners to invest. When you commit to become a limited partner in a fund, you don't give all the money you committed day one, because it'll be sitting in the bank doing nothing. What you do is you pledge, you will give, let's say, $1 million to the fund over a period of 6 years. When the fund finds a target, an investment target, they issue a capital call, which means they send an email to all their limited partners. Within 2 weeks, send us whatever is a pro rata amount for each partner, okay, for this investment. Let's say we'll invest 5 million in this company. Okay, I pledged 1/10 of the fund, right? So for this capital call, I'll have to put in 1/10 of the money. Okay, so this way, as an investor, I will give the money over a long period of time, but I have to be committed. If you fail to deliver the money, you lose it all. So it's a draconian, it's the penalty is like, that's it, you're gone. You lose all your investment. To make sure that people will not, say, I thought I would have the money, but now things are tough, no. There's no excuses. If you default, you lose everything, okay? But this makes it easier for investors because, again, you don't have to put all the money in day one, okay? The investment period for the fund is also important. Usually it's 5 to 6 years, okay? And then you wait for the companies to develop and hopefully exit, okay? Within a total period of 10 years. In investment, typically there is a lead investor, okay, which is whoever is usually will put the most amount of funds, and usually that investor will determine the valuation of a company. Okay, so if you have an investment round and there are multiple participants, many VCs or even individuals are investing, the one that has the biggest participation will usually dictate the terms. The rest will follow. Okay, so it's a very important role. And usually, after you make an investment, companies typically need additional money because they're on a growth path. And so you have what's called a follow investment, in which case you have already invested in a company and now you are asked to provide additional capital. Okay, obviously the decision is easier because first of all, you're already committed, but you also know the company, you work with them, you monitor their progress, etc. And there are these terms, pro rata, which is, you put in the proportion, drag along where you can force a minority shareholder to do something, or tag along where if somebody finds a good deal, you want to be able to take advantage of that deal. Okay, these are terms that are appearing in VC lingo. So how do VCs make money? Okay, now we saw how the founders make money. How do VCs make money? So first of all, VCs take management fees. Typically 2.5% of the capital is spent every year on offices, salaries for associates and the partners, etc. Now, the bulk of the return, however, is what's called a carried interest. And the carried interest works as follows. When you have capital gains from the fund, right, there is a minimum that the investors expect from you to give. So that there is a set annual return, let's say 6%, that the investor expects you to make for sure. If you exceed that, okay, you take a percentage of that, okay, in your pocket. So that's the carried interest, okay? So if your return exceeds the minimum annual return, okay, you get typically 20% of that in the partnership and you split it among the partners, okay? So if you have a $100 million fund, let's forget the 6%, the additional interest, okay? If you have a $100 million fund and your total return is $1 billion, okay, then out of the 900 million, the partners will keep 20%. Okay, it's not exactly that because you have to factor in the 6% per annum, but it's a small percentage. But that's how the VCs make money, because if they have the returns that they expect, then this 20% can become a significant amount. Okay, and they have multiple KPIs to do that. Multiple IRR. This is like the terminology used in funds. And usually VCs have multiple funds under management. So you have happy investing, okay, but under happy investing, right, there might be multiple funds, happy investing 1, 2, 3, and they're in different stages in a pipeline. So one of the funds might be divesting. Companies are mature, they are sold or they're closing. Another fund, you might be actively investing, okay, you're giving money to companies. In another fund, you might be fundraising, okay, so you are going to potential LPs and say, we have this, we're building this new fund, give us your money. And these coexist, okay, in a pipeline fashion, so that the partnership has multiple of such funds operating at any given point in time. Okay, that's the typical scenario. Okay, in terms of value, of course, capital, but mostly I would say is management experience, indirectly, but also because one of the partners will become a member of the board of directors of the company, so you have direct oversight. Business development connections is another, for supplier contractors and customers. And also access to follow-on capital, meaning it will help the company find additional capital when the time comes. I think the management experience and the access to follow-on capital are probably the two most significant challenges. Also when the time comes for IPO and acquisition, obviously they can help, but I will put that under the general sort of, board management experience category. Now, that's all in general. Let's look a little bit at the Greek ecosystem. So we had, in the past, we had good basic research, but very little commercial application, okay? And, work was done essentially, contracts for EU projects, etc. However, we had several startups since 2013, mostly business innovation, light technology, not deep tech. And there was a generation of funds called Jeremy back in 2012, 2016, but the funds were relatively small, like 15 million. A big change was Equifund, which was done in 2018, where essentially the European Commission, through the European Investment Fund, gave 300 million euros to Greece, okay, with support of the Greek government, to create funds that would sort of push forward the case for venture capital investments in Greece. So that was called Equifund. So Equifund was a fund of funds and invested in venture capital firms. And out of this process, in the areas that we here are interested in, there were two sort of called windows: innovation and early stage. And you can see here the 6 funds that were created. Big Pie, that's where I am. Unifund, Metavalon, Velocity, Venture Friends, and Marathon Venture Capital. So these are like the funds that were created. And in fact, I would say Big Pie, Venture Friends, and Marathon are the biggest in terms of capital under management. And Big Pie is probably the younger of them. It started 1 year later. Venture Friends and Marathon have already raised their second funds. So, which is like, they started with 50 million, now it's 100 million. So we're clearly seeing growth, if you wish, in the space of venture capital investment. So that's actually a very good sign. And of course, we also had several exits with Instant Shops, Automotive, which was sold to Microsoft. I mean, so the space has transformed over the past 5 years, which is definitely a very good thing. So Big Pie, where I am, is one of those Equifund funds. It's a 45 million euro fund, deep tech. And we started with Aristos Oxiadis and Marcos Veremis. And you can see a little bit of the stats. We have done 23 investments, 7 Greek research institutions. It's interesting that a lot of the founders actually are abroad. The Greek diaspora plays a big role here. And that's because, people go there, are trained, they get to know their markets. So it makes sense for them to start companies. It's a requirement for us to invest that you create a team here in Greece. Okay, but we have found the diaspora model to be particularly effective. Okay, having said that, we do have companies that were created through research institutions. In fact, 2 of our investments have ITE, the research institute in Crete, as an equity stakeholder in the company itself. Okay, so my personal hope would be that the numbers will be larger, but it is what it is. We have a long way to go in terms of bringing more, research from universities into companies. Okay, we have a long way to go. Okay. Okay, I don't want to say too much about the investment strategy. To get a sense, usually Big Pie and other funds, we get in with an investment of, from 500 to 1.5 million euros as a first investment, depending on the maturity of the company and how ready it is to use the capital. Okay. And would follow on with an additional 3.5, let's say, for a total of 5 million. That's kind of like the model, and it has worked well in practice. Meaning, this was the plan. That's actually how it turned out to be in reality. I want to say something about product math, and I'm just conscious of time. So maybe I'll say this. And I'll wrap it up. This is important, for researcher also who create technology to appreciate. So I created this to explain the following. You can have a product, right, and you have a delta in value and a delta in cost, and you can see here the different combinations. And I think these people here know math, so they will appreciate this. I wouldn't show this diagram to just anybody. So there is a delta value and delta cost, okay, and so horizontal is a value and this is a cost. And you can see the different ratios, right? So if you go here where I have the X, you have a delta value which is negative, so I'm giving less value to the customer, and the cost is higher. It's positive, so it's for more cost. So I give you less for more. Not a good product, X. Okay, forget about that. Another option is I'll give you more value for more cost. So I'll give you something better but more expensive. Nice, but it's hard to sell because I have to convince you that the incremental value I provide is worth incremental cost. Okay, it's like having, I don't know, like a cake and you have some icing. Do you want a cake with the icing or without? I don't know. I mean, it depends how much it costs, right? It's not clear, right? You have to make a case. A better situation where I give you more value for lower cost. So with video, where we're doing video conferencing, we're giving a better solution, better quality, more scalable, etc., and it costs less. That it sells by itself. If the other person understands what you're doing, the answer is obviously I want it. Is it ready? Where is it? So that's where you want to be. Okay. It doesn't mean that the other one doesn't work. This also is true It's also true for new products. Okay. This part, but it's harder to sell. Okay. And the final one is here where you have less value, but you also have less cost. But the less cost is much lower. Let's say I give you half the value, but 1/10 the cost. There are situations where this can be actually beneficial. Okay, so when you think of a product or something that you want to sell, I think it's very useful to put yourself in the framework of where exactly am I in this space, because it will determine how easy it is to sell your solution. And this, for example, here, this means you'll have to spend much more money, let's say, in marketing, because you have to convince people about how important your solution is. So it has ramifications, and this is something, by the way, you cannot change it after you create the product. I mean, it's part of it's part of the DNA of what you create. Okay, and so when you approach a VC, by the way, it's very important to have clarity on this. Okay, most people don't. Okay, what I want to do is maybe that might be a good way to close it, to show what happens when you have a research team create a company. And this is not very well understood. This is taken from Oxford University, from the Technology Transfer Office. So usually you have a research group that has a head and has postdocs, PhD students, etc. When the company is created, the expectation is that one of the people has to move to the company and become a full-time employee. So somebody has to stop becoming a researcher and become a part of the company. Typically, the research group head might become an advisor, like chief scientist or some sort of advisory role. Typically, these people will not quit their jobs, let's say, and join the company, even though it has happened. I quit my job at Columbia to go to video, but not everybody wants to do that. And then, you have a much smaller, group of scientists within the company, and then the company needs to build up in terms of, production, sales and marketing, financial administration, etc. Okay, and oftentimes you might need to hire somebody to manage it if none of the people who joined from the team in the university can basically step up and take the role. Okay, so that sort of transformation is very important. And so for somebody who is thinking of commercializing technology, right, they have to think of how it will work out, who will join the company, and how all this infrastructure will be set up. Because it's very important. If you build a company, you want to have the technological know-how within the organization. You cannot just hire somebody else to implement it. You need people who live and breathe the technology to be part of the company. Okay, so that's, I think, is a prerequisite. Okay, good. I think that gives you a good overview. I mean, I have 2 other slides on intellectual property and copyrights. We can discuss them maybe in a Q&A, which is important caveats, I would say, for people who work in research. And I don't know, I should probably, yeah. Okay, so maybe let me say that, because it's often misunderstood. For the technology company, patents are very important because it's a way to basically make sure that the competition cannot copy you, at least in theory. In practice, it might be more complicated than that. So in the US, the Constitution allows for patents, which basically tells you, tell me how you did something, tell the public. So patent is a public document. Tell the public how you did something. In exchange, we, society, will give you the exclusive right to commercially exploit it for 20 years. Okay, so in exchange for public disclosure, you get the right of exclusive commercial exploitation for 20 years. Okay, so that's very important, and a lot of companies are built around patents, especially companies coming out from research and universities and what have you. It's very important, however, to file before you publish. If you publish, it became public information. You lose your patent rights. So it's very important, if you have something which you think might be commercially relevant, to first file a patent. It's not expensive. In the US, it can be very cheap. Okay, but I think in Europe and Greece, it's not very expensive either. And timing is extremely important. It's also important to make sure you have all the inventors. In the US, if you miss an inventor, it's a reason to invalidate a patent. Okay, it's so serious. Okay, and who is the inventor and who owns the patent are two different questions. Okay, the ownership is a different question, and typically the owner will be the person you work for. Okay, but it's not clear. So when you work in a university environment and there is an invention, it's very important to ask, who owns it? Is it the university? Is it in Greece particularly, it's not clear. And you have to be clear when you go and approach somebody for investment, okay? Because there needs to be a clear paper trail of who invented what. And by the way, and I explain to people, let's say I work with Konstantinos on something for 3 years, okay? And somebody walks in, to deliver the coffee, sees the whiteboard and says, oh, why didn't you do this? Okay? And suddenly we're like, oh, that's it. Yes, thank you. He leaves. Okay, and now you write a patent, and then in the claims, it includes what this person said. He's an inventor. It doesn't matter that he walked in, spent 3 seconds, and gave us the idea, and then we worked out, like crazy for 2 years. No, it's not an academic paper. You don't get brownie points for participating. You get brownie points for contributing to the claims. Okay, so that's very important, right? And the other thing which is important for universities is the copyright, which is also subject of intellectual property. Copyright is created by putting something in a tangible form. Writing a piece of code, I immediately have a copyright just because I created it. Okay, I don't need to go and register it anywhere else. Okay, and the duration here is life of the author plus 70 years. Now, the important thing here for software like created in university is if you have let's say, a student who comes in for a month in the summertime, writes some code and leaves. Later on, this piece of software becomes part of a product. Okay, that person has a copyright claim on the software. Okay, and so he or she could come, 10 years later and say, I wrote the whole thing. It's my code there. Okay, so that's why it's very important to also, when you have contributors in a software project, to know who did what, and in fact, ideally, to have a copyright assignment, which you normally have if you work for somebody. But again, in a university environment where you have students coming in, it may not be clear that there is a relationship, and so the student might have to explicitly give the copyright. In these cases, if you have no paperwork, what you do is you find the contributor and say, look, we're creating a company. Okay, do you want to be part of it? Yes, no. Here are some shares or whatever. Find an arrangement to basically include this person, either by making part of the company or giving them some sort of compensation. And typically, stock might be the easiest way out. But you cannot ignore it because, it's very important. And the final thing on intellectual property and copyrights is the so-called copyleft licenses, meaning, it's okay in the university environment to go and copy code from wherever because you just want to make your experiments work. But some pieces of code is from software that if you use it, okay, it's open source. And if you use it, you are required to make your own software open source. Okay, that's called viral. Because if you touch that code in your code also has to be open source. Okay, so that's a very important thing to look at. When your company is sold, there are, usually a few people will come, long hair, okay, and will sit in your code, okay, and go through the whole thing to find traces of this code. And if there is one, you are dead. It's very important, okay? So you need to address that early on and find replacements, basically. If you use some sort of open source tool, you need to mark it up and make sure as you grow that you find a replacement. Okay, I'll stop here. We'll have the Q&A. We can address it. I don't know if I have time for questions, but thank you for listening. Okay? Thank you very much.
Okay, thank you very much, Alexandra. Very, very, useful and insightful. So, questions for Dr. Professor Mr. VC Eleftheriadis. Yes, Igor.
Amidst all the scary stuff, like publish before doing a patent, before publish, you write, he writes, it's whose is his. You don't even keep track of who like wrote which piece of code, and one for loop might have been open source. But I am trying to understand that where would you start as a researcher? Would you try to be product first and then try to build this whole administrative structure around the product? Or would you actually rather want to start with the administrative structure, like maybe even plainly just have a trademark, and then try to build upon it and just transfer the product over there?
No, I think you would start from the product. So you first have to think of the value you bring to a customer, think how you will create it and how it will be delivered, right? Conceptually, initially, right? And then you start building an infrastructure to make it happen. Okay, so you have to first have a vision of what the product will look like, how it will work, right? How it will be delivered, right? And you then start the process of convincing people to join you to work on this. So that's very important. So, because people have to leave their jobs, let's say, and join you. And investors, if you don't have the money, presumably you would need the money. So usually the founding team, the CEO, is in a continuous process of evangelizing the company to prospective employees, so you can hire good talent to come in and help you implement the vision. And investors will give you the money to invest. And slowly, the rest, the infrastructure will be slowly built around that. But the company is built around the deliverable, around the product. Okay?
Yeah, I did start with this question because sometimes contracts can be scary. Like while you work and you do something maybe on the side, you have an idea, and these things can actually live in parallel. And sometimes it can be scary that who can actually have claim on the product when you actually don't know that he had claim. I don't know if this was just a joke in the Silicon Valley, because he worked on that laptop and he came to work and he worked on something that's totally unrelated to his main job. Technically, the company had claim on his product. So usually that's why I'm asking this question, because it sometimes sounds scary to have the product first, because say you succeed, many of these power play and politics.
Yeah. Sorry, caution. I didn't say have the product first, the product idea first. Okay.
Okay.
Yeah. So look, if you cannot build a product on your own. Even 2 or 3, 4 people, you don't build a product, even though you think you're building. You're building an initial concept of a product. Okay, a product is not a product unless you have a mechanism to sell it, support it, etc., right? So normally what you would do is you'll create. You might have the idea, right, and the solution. You have let's say the mathematics, etc. Okay, you could even start just from that. If you have credibility as an entrepreneur, that might be sufficient. People will believe that you can build it. Okay. If you don't have that credibility, you might need to build a prototype. So you and a couple of friends who are the co-founders might build a prototype to demonstrate that it works. It's not a product yet, it's a demo. If that's when you collectively decide we're going to move forward, and at that point you start incorporating, you decide what equity each founder has, and you start bringing people on board. At that time, of course, yes, you have to have agreements with everybody. You have to be very careful, okay? So I was referring to the initial stage, right, where you create the product in your mind, okay? Because to build a product will take years, 4 years. I mean, it might take 2-3 years before you are ready to sell something, really sell it, right? So you go through various stages, early version, MVP, right? Minimum viable product. It might take a while, right? But yeah, at some point, you need to convert, let's say, to be full-time. And at that point, everybody needs to sign agreements, employment agreements. You need to have an infrastructure. Yeah.
And I guess according to what Katerina said earlier, you need to pivot it, right?
Pivot is also,
the concept.
Pivot is, might be called for. Yeah. Yeah.
Any other questions in the room? Any other questions on the chat? None. Okay, so maybe one brief question by myself. So, what do you think the outlook in Greece is for the VC community, and also the opportunity and the offer?
I think when we started 4 years ago, I was a little bit skeptical in terms of what types of companies we would be seeing to invest in, etc. I think we're pleasantly surprised. especially again from the diaspora Greeks, but not alone. So what I've seen is excellent companies, very good founders. Thankfully, we have investors that are willing to invest. So with Big Pi, we're setting up our second fund now, okay, which is going to be bigger. It's going to be 50 to 80 million euros. And I have to say that, you know, the appetite of limited partners to invest has been extremely strong. So we won't have a problem finding the private capital we need. And I wanted to bring up this example of Akisonos, since you mentioned it. I think it's a wonderful example. 2 PhD students out of Patras, they finished their PhD, they started the company, they got help from Michael Janes, an entrepreneur, Greek entrepreneur. He lives in Boston. And they built the company. I was actually an angel investor there and Big Pi invested as well. But over the period of 10 years, they became a very well-known company in the space of software for music applications, plugins. If you Google them, you know, they are listed with all the top-tier names. And they were in the news recently, you know, because I cannot say anything about it, but apparently, according to the news, Facebook had something to do with them. So what I'm seeing now is, again, Greek companies develop meaningful technology through, you know, deep technology. And not only that, but big companies from the US, like Microsoft and like Meta, you know, see the opportunity. They're willing to invest and set up shop here. And what I see for the future is, and that's happening a lot in the US, but it will start happening here as well. The people, let's say in Akisonos or in all these companies that were acquired, the people that work in these companies, they'll work for 3-4 years, they'll get bored, and they'll go out and start their own companies. And so they will essentially have done excellent schooling, right, in these organizations, becoming part of the Greek branch of the big company. And then in 5 years, I hope to see them in our doorstep, okay, with a great idea to start a new generation of companies, okay? And hopefully, the way this works, if they will be successful, they'll make tons of money, they will give some of that to VCs of that time, and the process will continue. And I think that's, you know, I think that's good. Yeah.
Excellent. I guess we're not using... So, T, I guess it's not the sound system you're using for the editing of today's show. This Akisonos, are you aware of it? Okay, maybe next year. Okay, let me thank our speaker again.
Thank you. Sorry for running.
Thanks a lot, Alexander. No, it's great.